A very good evening to you all, friends. I'm Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board. I welcome you all to this 144th program of AASB. And today's topic is expectation gap and basically the role of the fraud risk assessment. And to take that session, we have a very eminent faculty, CA Lalit Kumar from Wakat India. Lalit is also a special invitee of the Auditing and Assurance Standard Board and has always supported the cause of the profession. And we have with us our moderator, uh, Hitesh Bhai, who is the Vice Chairman of the Sonipat branch. I welcome both of you and I welcome all the participants. In our program, more than 1 lakh participants have benefited by attending the previous 143 programs. And I'm sure that today's participants will also be immensely benefited by the deliberations. May I now request Hitesh Bhai to give his opening remark and also introduce the speaker for the day, Lalit ji. Thank you and over to you.
Yeah. Thank you, sir. Thank you so much for having me here as the moderator of this 144th webinar of the Auditing and Assurance Standards Board of ICI. टुडे हमारा टॉपिक है एक्सपेक्टेशंस गैप इन ऑडिट एंड रिस्पॉन्डिंग टू फ्रॉड रिस्क, जो काफी इंपॉर्टेंट टॉपिक रहने वाले हैं। तो आज इस टॉपिक के लिए हमारे साथ जो स्पीकर हैं वो काफी महान हस्ती है, श्री ललित कुमार जी। इस तो आप सब लोग इनको जानते होंगे, लेकिन फिर भी मैं एक फॉर्मल इंट्रोडक्शन इनका दे देता हूँ। तो इनका ललित कुमार जी हैज 25 years प्लस एक्सपीरियंस ऑफ बीइंग अ सीए, और उन्होंने काफी डिफरेंट सेक्टर्स में काम कर रखे हैं, नेमली आईटी, टेलीकम्युनिकेशन, रिटेल, मैन्युफैक्चरिंग, फाइनेंशियल सर्विसेज, इन सब में उनका एक्सपर्टीज है। और आईसीआई से भी काफी लंबे समय तक ये जुड़े हुए हैं। जैसे सर ने बताया कि अभी ये स्पेशल इनवाइटी भी है AASP बोर्ड ऑफ आईसीआई के साथ। तो और टाइम ना लगाते हुए ललित सर, आप सेशन प्लीज स्टार्ट करिए। ओवर टू यू ललित सर।
Thank you, sir, Chairman sir, and thank you, Hitesh ji. Thank you, Anil ji, for asking me to give this today. Right, topic, as Hitesh bhai has just mentioned, is a very hot topic actually, and it is hot not only today but has been hot for a lot of number of years. Perhaps I would say this is something that people have always tried to assess what it is and what is that we can do. So we'll try and see what people have talked about audit expectation in today's presentation. We'll talk about these things. We'll also try and see what are the things that we can do as professionals to you know to ensure that the expectation gap is minimized and we are able to meet the expectations that public has from us. Right. Anilji, is my slide visible?
Yes, sir. Yes, sir. Yes, sir.
Okay. Okay. I will just quickly do stop share and share it again once. To speak. Yes. Okay. I hope the slide is now fully visible on the screen.
Yes, sir. Yes, sir. Yes, sir.
Now, like I said, this topic is one of the most important matters of conversation at the forums. So most of the forums where you will go today, where accountants gather and talk about audit profession, expectation gap is one thing that takes the center stage. This topic of audit expectation gap was first, to my knowledge and understanding, was comprehensively dealt with by a report that was published by Association of Chartered Certified Accountants in 2019. IAASB also picked up this topic for their research purposes, and they also published a discussion paper on exploring the differences between public perceptions about the role of the auditor and the auditor's responsibilities in financial statements audit. This report that ACCA published in 2019 was also used by IAASB when they published their paper. So when we talk about the expectation, I think there is no need for a reference point, but there are two very famous quotes that I would want to begin the discussion with. Is one is by Mr. Ramalinga Raju. This quote was given by him post scandal, and what he said was that the greatest threat that is there in our financial markets is not volatility, but it is fraud. That's out there pretty much in the businesses that we see around. We work in a very challenging environment, and we need to be very sure that whatever work that we are doing in an audit of financial statement responds to that risk. So if I pick up what Warren Buffett had said on risk, risk comes from not knowing what you are doing. So both the quotes are relevant for today's topic. What is that we are going to talk about? When I was thinking about this session, the immediate first thought was, should we simply talk about what SA 240 is and go through the requirements of SA 240? The standard is small, but there are a number of pages that are there that explain how the standard is required to be implemented in an audit of financial statement. But then I thought, let's not delve into detail uh, of the requirements of the standards, though it will be there as part of our conversation. But let's look into what really is the audit expectation gap. We'll talk about some statistics to build upon the discussion on audit expectation. There is an entire financial reporting ecosystem that works, and it has got several components. Each component has its role uh, in the financial reporting, in the auditing practices. And then we will talk about SA 240, what are the key requirements in SA 240. One of the key things that SA 240 revolves around is exercise of professional skepticism. We will also touch upon this topic to understand what professional skepticism is, what are the challenges that may be there for a professional accountant when professional skepticism is to be exercised, and uh, how can a practitioner improve exercise of professional skepticism. We will then sum up to see uh, how do we address the gap. Addressing the gap is not the responsibility of the sole practitioner. It is responsibility of the firm. It is responsibility of the regulators and standard setters. Everyone has to come forward and try and address this expectation gap. So this is what we're going to talk about. Let us look at some statistical data on the frauds. On your slide, you see two boxes. One is the detection box and the other is the schemes box. Right. Now, the data that you see on your screen provides an insight into the enormity of the issue. This data is taken from a report that was published by Association of Certified Fraud Examiners. They came up with their report on occupational fraud 2022, which, you know, covered the costs, methods, victims, perpetrators, and outcomes of occupational fraud schemes. This data has been derived from more than 2,000 real cases of fraud affecting organizations in 133 countries and 23 industries. Let us go over first a few numbers. On the left side, you see detection, right? What are these detection figures? These detection figures indicate that of all the frauds assessed, approximately 42% were detected by tips from some source or the other, and more than half of these tips were generated from employees. This makes it very clear that the employees who work at the grassroots level have the most knowledge of what is going wrong and where. The second point on the detection box is that email or web-based reporting mechanisms surpassed telephonic hotlines by a good margin, where emails and online forms covered 40 to 33%, 40 and 33% of all the frauds reported. Telephonic hotlines accounted only for 27% of these cases. The presence of fraud hotline has enabled organizations to detect frauds faster and reduce losses than organizations without a fraud hotline. Now let us go to the right column, right box, which is on the schemes. If one tries and understand, categorize the frauds into two portions. One is the misappropriation of assets, and the other is the financial statement fraud schemes. One would note that asset misappropriation schemes are the most common at 86% of the cases, but cause a relatively less loss, which is $100,000 on an average, whereas financial statement misappropriations are less common at 9%, but cause much bigger losses, with the average being $593,000. All global regions have one common scheme of fraud, that was corruption. So corruption is most widely done fraud across all regions. Another interesting fact in these fraud schemes identified was that these last for at least 12 months before being detected, and on an average cause a loss of 8,300 per month. And lastly, with the introduction of cryptocurrency in the mainstream transactions, 8% of the frauds involved the use of cryptocurrencies for settlement, of which bribery, kickback accounted 48% of the cases, and misappropriated assets conversion, another 43% of the cases. Let us now move on to other aspects of the report, which talks about perpetrators and anti-fraud controls. If one were to think about who are the people who are in a position to perpetrate frauds the most, just take a pause. And if you are guessing that promoters and owners of entities are in a better position to perpetrate frauds, you are absolutely right. Based on the study, although 23% of the frauds were caused by owners, they accounted for the largest dollar value of $337,000, which means that if you add up the other frauds that are done by managers or employees, they will not even become 50% of the frauds, or the proportion of frauds that were done by promoters or owners of the entities. What is very interesting, the study and the report points out that a thumping majority of 85% of the fraudsters displayed behavioral red flags. And these red flags normally include living beyond means, financial difficulties, unusually close association with vendors or customers, control issues and unwillingness to share duties, irritability, suspiciousness or defensiveness over work activities, divorce or family problems. So they were, I mean, always these are the red flags that are there with fraudster, always. 83% of the cases, 85%. The other interesting fact is to note that a fraud mindset seems not to be a recurring behavior. If we look at the profile of the perpetrators of the frauds, 94% of them did not have any prior conviction or relation to any types of fraud. So they were new in the fraud world. Only 6% of the perpetrators had a prior conviction related to fraud. The report also talks about anti-fraud controls. It says that the presence of anti-fraud controls is directly associated with the lower fraud losses and faster fraud detection. The second point that is worthy of noting is the reason of occurrence of fraud is interestingly around 29% due to lack of controls, whereas around 20% due to override of existing controls, which means the controls that were put in place were overridden. And lastly, and most interestingly, the victim organizations have taken cognizance of problems and over 81% of them modified their anti-fraud controls. So once the fraud came to light and they saw what was the reason, they had to update their anti-fraud controls. Also, 75% of the 75% increased their management review procedures, while 64% increased use of data analytics to proactively assess frauds. So these are the changing landscapes or some data points, which are very important to set the context. Now, when this kind of frauds are there in the corporate world, and the normal thing that we hear, or the first thing that we hear whenever a fraud comes to light, is what was the auditor doing? Why the auditor did not detect the fraud? Could it have been detected? And then comes into discussion the audit expectation gap. So let us now delve into the audit expectation gap, and this is where the ACCA paper, ACCA report on closing the expectation gap. I'm using this chart from that paper that was published by ACCA, and it very beautifully defined audit expectation gap. It categorized or bifurcated the expectation gap into three buckets. The first bucket is the knowledge gap. The second bucket is performance gap. And the third bucket is evolution gap. What do we understand between what is knowledge gap is what the public think auditors do. It is in their minds. Auditors are capable of doing X, Y, Z versus what actually auditors are doing on the ground. Or versus what auditors are supposed to do, considering the professional standards. That constitutes knowledge gap. Performance gap is something between what auditors actually do on the ground and what auditors are actually supposed to do when standards are applied in letter and spirit in an audit. And the third is the current state of standards. What is that the standards ask an auditor to do? and what is that public expect that the auditor should be doing. We will touch upon these three gaps in a little bit detail, right? The survey, this report was based on a survey that was conducted by ACCA, and the survey ran across 11 countries. And some interesting facts that came out from that survey was that 34% of the respondents correctly identified the role of an auditor, which means a vast majority of 66% did not identify. So the question was, survey was placed, and people were asked what are the responsibilities of the auditor, tick mark, and only 34% identified. The survey also asked the question on what items would you find in an audit report of a public interest entity. And surprisingly, a relatively high number of people who responded to the survey did not know the components of an audit report. Another question that was there in the survey indicated that 55% of the respondents believed that existing auditing standards, if followed, would prevent company failures. So that is the extent of what people's belief are. Now, if we take a few examples of what public thinks and what auditors actually do. Public thinks that all transactions are examined in depth by the auditors, whereas the auditors do perform test check procedures to address the risk that they identify, and the risk could be the risk of error or risk of fraud. Auditors always are required to gather persuasive audit evidence rather than conclusive. So when an audit report is published, everybody believes now this is a conclusive stamp on the company's existence, company's profit, company's, balance sheet. Public also tends to believe that an audit is equal to investigation. The first thing that we would want to explain to a regulator, God forbid if somebody has to explain it, the difference between an audit and an investigation. The second aspect about knowledge gap is the misunderstanding of the role of the auditors. We've always talked about the famous Kingston Cotton Mill case, Bloodhound versus Watchdog. Somewhere public expects auditor must detect all frauds, and no frauds can happen if the auditor is diligent. Public also does not understand, and when I say public, it could include anybody who uses our report, including regulators. There is misinterpretation of the requirements of standards on auditing or ethical requirements. Our code of ethics lays down what are the principles that one should follow to safeguard independence. There are some services that are prohibited, some services which are permissible to be rendered. Sometimes there are situations where judgments are required to be exercised by an auditor. Now, while all this framework is there, a general misinterpretation or misunderstanding is if an auditor is providing any non-audit service, which might even be permissible, which might have even been evaluated by the auditor, cannot be done. Therefore, the auditor independence is compromised. Therefore, the report may not be good enough. Auditors are required to report upon going concern. When auditors write about going concern, people take it as a stamp on guaranteeing that company will continue to be a going concern. People believe that by complying with the standard on going concern, the auditor should be able to predict a company's failure. So this is broadly what we categorize as knowledge gap. Knowledge gap may have been used by some people in the profession to resist change, by depicting the problem as being due to public's lack of understanding rather than being a legitimate concern. But the existence of knowledge gap does not invalidate calls for the auditors to do more, which means that as a profession, as practicing accountants, we should not be using knowledge gap uh, as an argument to say that we can do only so much, we cannot do more, and we will continue to perform the way we are performing. So that's while it exists, it will continue to exist, uh, in some pockets or the other, but definitely it cannot be an excuse for not doing the work in accordance with professional standards. So this is what the study concluded. Now, what is performance gap? Performance gap is simply stated when you do not conform to auditing standards, and could be because of any reason. I mean, there could be lack on quality, there could be complex auditing standards that have come up. The requirements on how do you comply with auditing standards are not clear. There could be differences in interpretation of auditing standards or regulatory requirements between practitioners and regulators. The auditor may be under pressure because of the tight deadline, leading to an impact on the quality of work being produced. People may not be trained for the new accounting standards, technologies, and the changes that are occurring in today's circumstances. So there could be varied reasons on, which could lead to the situation of performance gap. It is very important that one understands the difference between the knowledge and performance gap. Uh, because when responsibility and accountability is to be assigned, one should be very, and somebody is examining, a corporate failure or looking at a situation, one should be able to clearly identify whether it is a performance gap or a knowledge gap that is occurring. The third one is evolution gap. It will also continue to exist. People will continue to demand more from the auditors. Uh, and audit as a function needs to evolve because there could be changing expectations due to development within the environment. Today, I believe people expect a more clearer reporting on companies' future viability. There is expectations around um, more transparency reporting being done by the auditors, right? Telling public at large on what they are doing to ensure that their independence is maintained, that the audits that they deliver are of high quality. So the environment is evolving at a very rapid pace, which may necessitate different and more robust procedures targeted at ongoing. All these things, you know, lead to, I mean, the evolution gap. Profession will evolve, profession will respond to changes that are occurring around us. There is a call for a broader and more holistic view of auditor's role beyond what the audit currently delivers. Right. So that's what evolution gap is. Now look at regulators' expectations, and if you follow what is being said in public by our own regulator, Honorable NFR Chairman, I think what you see on the slide is statements. I mean, I'll read it out. What has been said is we will also closely work with auditors to ensure that they perform the audits with professional skepticism, challenge management assertions on their financial figures, look at related party transactions closely, and seek independent confirmation and validations of transactions. Perhaps, and this is a sentence I like the most, perhaps it's time to go back to the basics of internal financial controls, as not all the corporate frauds were committed by very sophisticated designs, but by old age methods of fictitious sales and loans and advances, over invoicing of purchases, related party transactions, and due to failure of basic internal controls. I think the other, I mean, this is our regulator in the country, and there was a report known as Bryden report and published in UK, uh, and it provided another, you know, facet, uh, which is auditors be required to undergo initial and ongoing periodic training in forensics, accounting, and fraud awareness, which means that somewhere the role is expected to enhance from being a pure auditor to forensic accounting and forensic awareness. ARGA maintain an open access case study register detailing corporate fraud, which means opportunity to learn, uh, and then establishment of an independent auditor fraud panel to judge auditors' culpability. So these are some recommendations, some expectations from the regulators. But for me, more, the most relevant is what our regulator is saying, and uh, which appears to be the call of the time, is to go back to the basics, perform your audit work in accordance with the currently laid down standards. Right. So now let us look at the financial reporting ecosystem and the auditor's role. We'll briefly talk about these are five parties who are very important in financial reporting ecosystem. The first is the entity and its management. They prepare the financial statements. They are responsible for making sure that the financial reporting framework is complied with, responsible for internal controls. The second uh, team is those charged with governance, which means they exercise oversight, provide strategic directions, uh, uh, on the entity's financial reporting. The third one is statutory auditors. We will see what statutory auditors do in the later slide, but government regulators and professional bodies and standard setters, they also are a critical part. So they not only establish, but also enforce legal and other obligations, regulatory requirements, and develop accounting and auditing standards, which are sound. Investors, analysts, they use the financial reports, make investments, make business decisions, and make the country grow. For us, when we do audits, the first people to interact on the ground who share this responsibility more than us is when the two parties, one is the management and the other is those charged with governance. So when a fraud occurs, an auditor is questioned, the first statement that comes to my mind is, why only auditor is being questioned? Is it only the auditor who's responsible? The media seems to put focus on the auditor when there is a fraud, uh, and nobody critically evaluates what management did, or no actions are taken, or actions taken, if taken, are not visible in the public. If one looks at SA 240, the standard states that the primary responsibility for the prevention and detection of fraud rests with both those charged with governance of the entity and management. Management, along with those charged with governance, needs to place a strong emphasis on fraud prevention, which may reduce opportunities for fraud to take place, and fraud deterrence, which could persuade individuals not to commit fraud due to the likelihood of detection and punishment. This involves creating a culture of honesty, ethical behavior, which can be reinforced by active oversight by those charged with governance. If one reads the director's responsibility statement, there are 6, 7 assertions the directors make. The assertions are about preparation of the annual accounts in accordance with accounting standards, uh, selection of right accounting policies, making sure that the accounting policies that they have selected have been applied consistently, judgments that have been made in the preparation of financial statements are reasonable. Uh, there are anti-fraud controls that have been put in place. going concern basis is appropriate. All those are the responsibilities of those charged with governance. Let us see what the auditor is responsible for. Auditor is responsible for carrying out audit in accordance with standards on auditing. What the auditor does is lends credibility to the financial statements. Right? So the signature that we do on an audit report is powerful. Our signature indicates that standards have been complied and we have complied with all ethical principles in opining when in signing of this audit report. We are today also required to sign an audit report on the internal controls over financial reporting. So we also give confidence to the people to the readers of our report that internal controls are operating effectively. We are also required to help and work with those charged with governance. So when you talk to those charged with governance about significant audit matters, do your communications under SA 260. You're not only discharging your obligation, but also strengthening their hand and making sure that they are able to carry out their functions effectively in terms of getting things done from the management. If you are highlighting an issue that needs to be dealt with, when you tell them, they will go back to the management and ask them to do necessary steps to resolve those differences. Auditor's role is also to make regulatory reporting. So if there is a reporting that is required to be done under 143.12, if you come across a fraud, you have to do it. Most of the frauds relate to some type of non-compliance with laws and regulations. And if the entity that you are auditing is a listed entity and the updated requirements of the Code of Ethics on laws and regulations are applicable, you may have reporting obligations in that also. And when you do all these things, you instill confidence and trust in the stakeholders, in the government, and you strengthen the capital markets. That's what our role is. Now, looking at the statistics of the fraud, what the expectation gap is, and coming to, if we look at the three components of the expectation gap, can we deal with knowledge gap? As professionals, we have very little to contribute to minimize the knowledge gap. Evolution is something that happens at a professional level, at a country level. Very little for us to do there. But one area which is definitely within our hands to bridge the expectation gap or to reduce the expectation gap is to eliminate the performance gap. As professional accountants, as auditors, we should try and eliminate the gap to the extent possible. And this is where our SA 240 comes into play, and which tells us how do you respond to a fraud risk. The title of the SA 240 is, I think, auditors' responsibilities related to fraud in an auditor financial statement. So we'll go through now some key requirements of SA 240. So what are the auditor's responsibilities under SA 240? It's categorized into three buckets. First is it asks the auditor to carry out fraud risk assessment, which means how, why, where, when the financial statements of an entity could get materially misstated because of existence of a fraud. So identify, assess the risk of material misstatement due to fraud. Once you have identified the risk, and for example, the risk is you have identified a key performance indicator for, and I'm going to give you a very offbeat example in this situation, right? The head of administration of the company has a performance target of reducing the expenses by operating expenses by 25% to be entitled to claim 100% of the bonus that is allocated to the department. Now, you are clearly seeing a situation where 100% of the bonus of that individual is dependent upon reduction of 25% of the operating costs. Having identified this risk, you need to have an assessment done how this risk can get materialized and lead to a misstatement. And this will clearly indicate there is a risk of understatement of cost in the financial statements. Now, step two is having determined that there is a risk of understatement of cost, operating cost. You need to find out how it can be done. What are the test checks that you will do? What are the substantive procedures you will carry out? When will you carry out your test? Right. You have to design procedures which will respond to this risk. So the step two, which SA 240 says, respond by designing and implementing appropriate audit procedures. And the third is, once you have designed and carried out those audit procedures, obtain sufficient and appropriate audit evidence, evaluate it, and confirm or dispel the risk, or say, this was the risk, these are the procedures we performed. We believe that these procedures are sufficient. There are no indications that costs have been understated fraudulently. So this is what broadly SA 240 tells you to do, but there are concepts which are important for us to understand. Now, the next concept that we should briefly touch upon is the fraud risks. What are the fraud risks? Before fraud risks, I think let's go to types of frauds first. So as an auditor, we are always concerned with two types of frauds. The first type of fraud is misappropriation of assets, which means anything that is there on the asset side of the balance sheet, that is getting misappropriated. So it could be cash, it could be inventory, it could be receivables. Right. Misappropriation, if we look at the quantum and value of fraud, these are normally very small amount frauds, which may often be immaterial, but sometimes it can be of a very big effect when misappropriation is done by management or promoters or owners, when they have the ability to override control. So siphoning of money from the main entity to another entity where the two employees or two of the directors have control, and then losing the trail of the money, right? So depending upon who is doing this, employees, when they do misappropriation of assets, somebody will say, okay, factory building is being constructed, please send a truck of bricks to my house. Also, I will get one room constructed there. So could be a very small fraud, but when it is done by management or the owners of the entity, it can assume very large proportions because there is an ability to override controls. And overriding controls is nothing but just telling the control owner to ignore what is being done, and control owner will ignore because ultimately his bread and butter comes from the owners of the entity or from the top management in the entity. The other type of fraud which the auditor is always concerned with is the fraudulent financial reporting. Now, fraudulent financial reporting essentially means that financial statements showing something which actually is not the case. Right? Examples of fraudulent financial reporting could be selection of or application of accounting policies in an incorrect manner, making unreasonable assumptions in valuation of assets, or intentionally not considering certain events, transactions when preparing financial statements. So these are the examples where fraudulent financial reporting occurs. Now let us go to the definition of to the fraud risk, types of fraud risks that are there, and essentially four types. The first type of fraud risk that is normally there is at the financial statement level. When we say that a fraud risk is at the financial statement level, it may relate to more than two, three, four financial statement captions. So relates pervasively to the financial statements. And it will affect multiple assertions. So assertions we all know: completeness, existence, accuracy, valuation, presentation, and disclosure. And could also, I mean, ultimately be linked, or would also ultimately be linked to individual account level and individual assertion level. And financial statement fraud risk will normally arise when there is weak control environment. I'll give you an example of financial statement level fraud risk. Revenue recognition. This is also a presumed fraud risk in SA 240. Fraudulent revenue recognition can occur in an entity when premature revenue recognition occurs, or when revenue is recognized when fictitious customers get created in the system. In retail industry, fraudulent revenue recognition can occur when channel stuffing is done. Sometimes people also change the terms and conditions of the sales near the year end to make sure that they are able to recognize revenue. So, and revenue recognition is one of the presumed fraud risk because it is one of the most common ways to increase the top line. It is one of the most common ways to show the increased profits, which is more often than not the objective of making sure that people get to know the news what they want to know. When a revenue recognition fraud is done, it may affect several financial statement captions and assertions. The financial statement caption could include revenue, accounts receivable. For making sure that you are showing appropriate quantum of goods being sold, one will have to, fudge the purchases. So purchases, the cost of goods sold goes for a toss. There could be inventory that can get misstated. To cover up fictitious sales, you may want to, one may also, show fictitious cash receipts from customers and build up fake cash and bank balance. So you can see multiple accounts throughout the financial statements getting impacted. Existence and occurrence is a common assertion that is involved. Valuation also gets involved when we talk about inventories, right? In this, so that's a financial statement level fraud risk. When we talk about fraud risk at assertion level, considering when the fraud happens, so fraud risk at assertion level during the year. Now, when something like this is identified, it will normally affect the assertions of occurrence, existence and occurrence, completeness, accuracy, or classification, right? So these are the assertions that normally get affected. An example of this could be inventory theft and misstatements. So somebody comes to the stores of the company and takes out 25 packets of XYZ item from each of the stores. And this happens every week. Now, this is occurring throughout the year. What will it lead to? It will lead to, of course, misstated existence and occurrence of cost of goods sold. It could also, lead to a misstatement in the closing balance. It could lead to a misstatement in the loss, normal loss or loss of inventory. Right? So confined to a caption only, but something that occurred during the year, and it could occur because of weak internal controls or absence of robust accounting around inventory. Fraud risk at assertion level at the year end. Now, when this kind of fraud risk occur, these are normally on existence assertion with something, an asset or liability does not exist. It could lead to valuation rights and obligations, completeness assertion. An example of this could be inventory existence and valuation. Continuing with the previous example, when it comes to the balance sheet date, the inventory that might be there in the books of account will not be there physically. So inventory's existence and valuation both will go for a toss. Completeness of recorded costs will go for a toss. Another example of such fraud risk could be hiding a liability to show a better financial position. These things also do occur. Fraud risk at the assertion level, which is presentation and disclosure. The examples of this could mean uh, concealing accounting policy, the way you are accounting for a particular type of transaction, or misrepresenting accounting policy in the financial statements. There could be undisclosed related party transactions. That could also be fraudulent financial reporting. It could be misrepresenting contingent liability. So these are the examples, where examples of risks, captions, whatever you must say, which could indicate which are there, which an auditor should be able to assess. Now, fraud triangle is not a new concept. It's a very widely known concept as auditors. When we are doing our fraud risk assessment, our idea is to be able to come to at least 2 points: incentives and pressures and opportunity of the fraud triangle. If you see there are incentives and pressures on anyone, including management, to commit fraudulent acts, and if you see that there are controls that are lacking, there is zone at the top that is lacking, you are at least having two of the things to start with. I think that risk assessment gets over when you have two of these three components of fraud triangle. Rationalization normally comes later when you make your inquiries, when you confront somebody with the facts that you have. The explanations that get forwarded to you are rationalization. And when you're talking as an auditor to someone, you will come to know whether what is being said is rationalization of the acts that have been done or is the real reason, right? And that's where somewhere I think the auditing concept of do not rely on oral explanation, ask for documentary evidence. So when rationalization is done by somebody, when you're talking about fraud, please ask for evidence of what is being told, right? Let's go further. Now, how do you respond to fraud risk? Right. There is the entire cycle. I mean, I'll divide into three, 4 buckets, I would say, broad steps. The first step of responding to fraud risk is to gather information about uh, fraud triangle, right? Are there incentives and opportunities available for somebody to do a fraud? Rationalization, I normally tend to ignore when I'm doing my risk assessment because, like I said, it will come later on. So, how do you gather this information for incentives and opportunity to do fraud? Opportunity to do fraud is concluded after a thorough understanding of how the transaction passes through right from the initiation till the end of the transaction in the trial balance. We call it a walkthrough. And making an assessment where is an opportunity for somebody to break the control and do a fraud. So that is called opportunity, right? But let us also identify the risk. So you have to make a lot of inquiries of management, of those charged with governance. You need to have a very good knowledge about the industry in which the company is operating, to be able to gather the indicators of risk which may be there, right? So you make specific inquiries concerning fraud to management, internal audit function, others within the entity, those charged with governance, right? You make these inquiries. Then you look at financial statements also. We call it preliminary analytics. When we do an audit of financial statements, we look for, uh, evaluate whether any unusual or unsuspected relationships are there in the financial statement. Be attentive to changing trends. Be attending to, uh, changing ratios or ratios not reflecting the business situation in the company in the previous year or in the previous year or within the industry, right? Whatever trends you are seeing, are these trends as per your expectation based on your knowledge of the company's status of affairs or based on your knowledge of the industry? And when you see anything unusual, please be attentive, call for more information, and make sure that you are able to assess the risk properly. Depending on the entity's industry and location, it may be difficult sometimes to gather information, but uh, that's the call. We must have good information. We encourage, I mean, we exercise a lot of professional skepticism around these areas, uh, without simply or blindly accepting management's explanations. Once all the information has been gathered, as engagement team, do a brainstorming session and understand, you know, how fraud can be perpetrated. But to answer this question, you should be able to very clearly understand how the business that is carried on by the entity translates into numbers. When you are talking to your engagement team members, ask if they have seen anything, if they have come across any situation that indicate incentives or pressures. Right. Once you have done that, you will be able to come to fraud risk, and then you will design how is that you are going to respond to a fraud risk. What is important in responding to a fraud risk is standards make it compulsory for an auditor to test the controls for operating effectiveness when the risk identified is significant. And whenever there is a fraud risk attached with a caption, with an assertion, that caption and assertion becomes subject of a significant risk, and whatever internal controls are there to mitigate the risk that has been identified have to be tested for operating effectiveness. The other thing that one must keep in mind is test of control alone is not sufficient. You will have to design substantive procedures also responding to the fraud risk. So if you are doing simply a statistical sampling on a data dump and you do not find uh, any error in the statistical sampling, can you as an auditor be sure that you have responded to the fraud risk? The answer would be no. because statistical sampling will only give you comfort over error. So it will tell you statistically there does not appear to be an error in the number reporting, but if you have identified the risk of uh, uh, fictitious revenue recognition, which is a presumed fraud risk, and as engagement team, you have assessed that this can only happen when somebody creates fictitious customers in the customer ledger with fictitious PAN numbers and all particulars, only then somebody will be able to record a fictitious sales, right? Coupled with other things, this is one of the key controls. So you will have to see what are the controls that have been put in place by the entity to make sure that the new customers, no fictitious customers get created in the system. So you will have to test those controls for operating effectiveness. Perhaps at the year end also, you will have to verify the existence of the new customers created, right? So that's how you respond to the fraud risk. The third thing, which is very important and should be done when you are responding to fraud risk, is you have to built in unpredictable audit procedures in your audit. Managements very often uh, are aware of what kind of audit procedures are done by the auditors, and they prepare for it, and they give you the evidence, and you happily move away from the audit saying we have done what we had to do. Bring some unpredictability. The information that you ask for, the test that you do should be new to the management. There are uh, events, conditions which indicate pressure, incentives, opportunities. All these are mentioned in standards, but the information gathering phase, look for these indicators. So these indicators could include situations like significant portion of compensation of people contingent upon achieving targets that may now be not be attainable. If there are recent layoffs or potential layoffs, then there could be pressure for somebody to commit fraud. Uh, if there are recent decreases in compensation or threats of reduction, there could be an incentive or pressure. Management is motivated to manipulate the financial performance to achieve goals, avoid bankruptcy, which means deteriorating financial conditions. Uh, they want to qualify for government stimulus packages. They want to go for new financing. Uh, these are the indicators of incentives pressures. Regulatory environment also plays a very important uh, role in identification of risk. If jurisdiction has cases where people uh, have not been prosecuted, or they are able to overcome the law, uh, which essentially means that fraudsters are free to continue to perpetrate frauds. Again, it's an incentive. कुछ होता नहीं है, let's do it. If the internal controls are not designed or operating effectively, if they are not changed as the business is changing, it could be an opportunity for somebody to conduct fraud. If there are changes in accounting policies that are happening in the company, particularly revenue recognition, which are not directly linked to a change in accounting standard, possibly there is an incentive or pressure for somebody to do frauds. Judgments, if the financial statements need a lot of judgments, I think judgments always remain a matter of significant auditor attention, is an indication that there could be a fraud. And if you feel that tone at the top in the company is not good, or the entity is not good, which means the people, again, in the entity are not challenged to remain ethical or are not punished when unethical practices are done, there could be, a fraud indicator, events or conditions indicating pressure or incentives. Fraudulent financial reporting, growing revenues without corresponding growth in cash flows, consistent sales growth while competitors are struggling. I mean, still showing high sales volume. It could be a fraudulent financial reporting, right? If there are unusual large transactions, cash transactions that are occurring, then there could be indicators of uh, fraudulent financial reporting. Significant related party transactions could be an indicator of fraudulent financial reporting. So please remain alert, you know, uh, when you are gathering information and uh, evaluating, carrying out your fraud risk assessment. What I will do is now, Anilji, I'll need your help here. We'll present three case studies, and the way we are going to talk about, I'll simply first present you with the facts. So the facts here are that, and what the task is to maybe type in your comment box how, as an auditor, would you want to respond to these facts? Do you see any risk in these facts mentioned here on the screen right now? And how this would need to be responded, right? So the facts are the entity is a listed entity. Board is chaired by a well-known, powerful, and towering personality. Chairman is involved in taking financial reporting decisions. The audit team, which is working on the engagement, is working, I mean, with the client for the last 9 years. The entity is very profitable, very respected on the stock exchanges, and the industry in which the entity is operating is evidencing acquisitions and takeovers. Right. Now, with these facts, broadly, I mean, there is no right or wrong answer, but what are the first few things that come onto your mind? Can you type it in the chat box? How would you want to respond? I mean, do you see any risk there, and how do you want to respond to those risks? Anilji, can people, participants, type in the chat box?
Sir, due to the technical glitch, नहीं जा रहा था. They can write in the chat box only. They can write and in the question answer box, they can write, then I'll forward the same.
Okay.
Yes, yes, yes.
So just 2 minutes after, let me know if there are any right.
Yes, yes, yes.
Hmm. Anil, any responses? Anil ji?
आवाज खोलो. So we are trying to fetch, sir. I hope there is some technical glitch. Still, we are trying to fetch. IT team is also taking care.
Okay, okay.
Mr. Jay, please देखिए responses आए होंगे.
I think in the interest of time, मैं चलता हूँ आगे. There is another case study.
Yes, sir. Yes, sir. Yes, sir. Kindly go ahead, and at the end we will raise questions, sir.
Right,
And
right.
this relating to this case study also. Yes, sir.
Okay, okay. So possible auditor response, and these facts are very small facts that are given, but could indicate a lot of fraud risk, right? And where somebody could go wrong, right? So first is the independence and objectivity of the auditor might get challenged because the senior personnel in the audit engagement were involved with that audit client for 9 years, which means at at the firm level, for the first response would be to change the people who are there on the audit. And that's why we have our requirement in the ethical standards to do rotation of audit partners and key audit personnel after a specified period of time. Now, the facts also indicate that there could be a significant pressure to meet market expectation because highly profitable and respected entity in on the stock exchanges, the promoters would want to, uh, maintain the stock prices, would not want the stock prices to go down because they might have the fear of the entity getting, there could be a hostile takeover if the prices, of the stock come down, right? Now, these are, I mean, this is a very big risk, which is which is there and is there almost in all the listed entities, right? How would the auditor now respond? I mean, having assessed this risk, how would the auditor respond? The first task that the auditor will need to do is identify, based on the understanding of the way the entity operates, based on the understanding of the business, based on how the controls are designed and implemented. First thing that the auditor will do is identify which account and which assertion of the account can be susceptible to fraud risk. Right? And to be able to make that assessment, there has to be a thorough understanding of how business translates into revenue, profits, and cost. You might have to decide to test controls for operating effectiveness, as we just mentioned, I mean, read in the previous slide. Since this could be a very high level fraud, there is a very high chance of management override of controls. This is again one of the presumed fraud risks in asset 240. So you will have to design test of journal entries to see how they may want to increase their revenue or show profits. For example, one of the means through which profits can be overstated is by capitalizing cost. So if you see that the entity is undergoing uh, heavy capitalization, uh, and no harm in somebody, putting a journal entry, debiting fixed assets, crediting expenses, thereby increasing profits, right? So again, depends on whether it is possible or, there are incentives, pressures within your audit client to do it. This where journal entry comes into play. And this, by the way, happened uh, in a very famous accounting fraud, WorldCom. The expenses were capitalized to show profits. Okay, then perform substantive procedures. So I think given these facts, the auditor could have responded, but let me tell you, the fraud occurred. Uh, and like we always do, somebody tried to find out what auditor did, what auditor actually did not do. We are not commenting on what the auditor did or not, but these are the possible actions that could have been taken. The fraud, when it got unearthed, it was an accounting fraud that was orchestrated by the company's founder. The revenues and debtors were overstated. There were non-existent cash and bank balances, non-existent accrued interest, understated liabilities, which means they were undisclosed funds infused in the company but were not shown as liabilities on the balance sheet. Uh, to to deliver the kind of revenue that the company was showing, they had to show fake employees also, because it was simply not possible for somebody to generate that kind of revenue with the X number of employees. It had to be multiplied by X had to be multiplied by 2 or 3 or whatever factors was used, right? I think that's case study one. Let's go to case study two. Again, it's a listed entity. The auditors in the company had previous relationships with the audit client. The entity was part of a very complex group structure. Uh, and equity in the entities of the group was financed by borrowings, related party transactions. The entities were investing in long gestation projects. There were backlogs of dividends, interest, etc., and short-term borrowings were used for long-term purposes. If these are the facts, what will you identify as fraud risk, or what are the things that you will see as incentives and opportunities, and how will you respond, is the task. And again, I'll Anilji, have we sorted it out, or should we keep it towards the end only?
Sir, we will do it at the end only.
Okay.
Okay.
So the possible response here would be, obviously, since you have previous relationship with the audit client, please carry out your assessment on objectivity, see if there is any self-interest or self-view threat that is getting created. When you do your fraud risk assessment, complex group structure uh, would get categorized as an opportunity for hiding transactions or losing the money trail. Repayment of debt obligations, because there is debt that is financed and you have used short-term borrowings for long-term purposes. There could be pressures for you to generate fake cash flows. Long gestation project is another indicator of a pressure for somebody to say that the due dates of the borrowings will come and you may not be able to generate cash to pay them. Backlog of dividend, interest, etc., are already existing indicators that you're not getting dividends, you're not getting interest from the money that you have paid, simply because they are your entities or your related parties does not mean that everything is good and hunky-dory. And going concern could also become an issue, right? So I mean, these are incentives and pressures and opportunities that you are seeing because of the facts that are getting presented. How would you respond to the fraud risk? Where will the fraud risk sit in this? I think here, as an auditor, when I am responding to fraud risk, I would be very keen to understand how entity manages asset liability mismatches and how they are generating cash to pay the liabilities. When the team is actually doing audit on the ground, uh, about impairment testing of the investments, one will have to have an understanding of the asset. When I say understanding of the asset, means what is the business in which the entity, in which the money has been invested, carries on the business. What are the nuances of the business, whether the cash flow projections that have been prepared are reasonable and reflect what the industry shows. What are the internal controls that are there for making sure that the estimates are appropriate? Possibly one would need to involve some specialist also when looking at these test work. So that is how, considering the facts, identifying opportunities, pressures, incentives, and then the auditor has to respond to the risk. And the actual fraud that occurred on this was that when it was unearthed, it was found that investments were overstated. There were transactions with related parties that did not comply with the applicable regulations, and the entity eventually had severe liquidity crisis and defaulted on debt obligations. We'll skip case study three. I mean, this is a different case study, but we'll skip for the sake of time and maybe take it at the uh, later session. But in how so? You may see a number of case studies there, but one thing that I've always felt at the bottom of it, was it rocket science? Answer always comes out as not, possibly not. Was it difficult? Answer is yes, it was difficult. Because of the sheer effort, the sheer knowledge, the sheer input that goes into, uh, you know, conducting an audit of financial statements, difficult, but then pick up the jobs that can be executed in accordance with the standards. If you cannot do a job, one should not pick up that job, is the principle. So let's delve into professional skepticism for some time. And again, I mean, this is not an interactive session, but the question to you is, what do you see on the screen? Anilji, Hiteshji, what do you see on the screen?
Sir, two persons watching towards each other.
Okay. Hiteshji?
Sir, though a person without brain, I guess, without head.
Or a cup?
Or ek, sir, we can say that is the trophy type cup is there. You can say.
Yeah, yeah. Absolutely. Absolutely. All answers are right answers. What do you see here in this picture?
In this picture,
A lady waiting for someone, and it's quite windy.
Hmm. Okay. And you're seeing a young lady, right? Whose
Yes, young
head
lady.
is turned like this. And I'm sure there are participants who are seeing an old lady also. And now when I tell you an old lady, are you able to see the old lady also? Old lady with the chin towards the neck, you know. Okay. I think these are pictures which can have multiple meanings, which means that for something to be understood, there are more than one ways to look at it, right? And for somebody to come to a right conclusion, it is absolutely important not to make guesses, but to go and ask the right questions. This is what professional skepticism is, which means that it is an attitude that indicates a questioning mind and a critical assessment of audit evidence. Now, does it mean that you always approach a situation or always think that the audit client is a fraud? Answer is no. Do you always think, should you always believe that whatever your audit client is telling you is correct? Answer is again no. The skill lies in that whatever you are being told or you are being shown, you look at it the way it is without any bias in your mind. And bias is something that we will talk about in a little while. Without any bias, you look at something, examine that thing, ask questions, gather more evidence, look at it in that fashion, and you are able to conclude maybe. But there could be a situation where then you will start believing something is wrong. Your audit queries will become little more probing and may ultimately have to, conclude that it's a fraud or do necessary procedures. But to begin with, it is a right skeptical mind with which an audit has to be carried out. So this is what professional skepticism is. Now, like I said, there should not be any bias in your mind when you are looking at something or evaluating an audit evidence. The slide here talks about certain biases that might be there in our minds when we look at audit evidence. We need to be cognizant of these biasness and overcome these when we are doing our audit. So first bias that I will take up is confirmation bias. Confirmation bias essentially means that people tend to value evidence that corroborates their existing beliefs more highly than evidence that contradicts them. For example, an auditor may tend to over rely on weak evidence from an analytical review procedure where the results corroborate the balance being tested. I'll give you an example. Uh, the management tells you we normally increase the payroll by 10% each year. And you see a 10% increase in the personal cost recorded in the financial statements. Now, this is a confirmation bias. The thing that you are seeing on the paper, which is a 10% increase, is confirming to what the management has said, right? Now, this is what we call a confirmation bias without getting into the components of the cost. For example, the level of people, the changes in the salary given at each level. So, for example, 10% increase is not justified because your top three executives who were or middle level management who was getting 50% of the cost of the company was fired during the year or left the company during the year. But then there is no reason for the cost to go up by 10%, right? So this is an example of confirmation bias where you get some evidence and you are trying to quickly conclude and link it to what you understand, right? 10% is what we are told, 10% is being shown, this is okay, without getting into detail, right? Then there is something called anchoring bias. Anchoring bias is people tend to use initial piece of information as an anchor against which subsequent information is judged. For example, uh, you know, the finance director of a company, you are having a conversation, he has given you a piece of evidence to support the statement that is being that he has just made, or he or she has just made. And the moment uh, uh, the auditor questions that judgment, right? He may start questioning the auditor and would want the auditor to anchor his thought process on what is being told. That's known as anchoring bias. Let's talk about conjunction bias, for example. Conjunction bias is when people tend to think of specific circumstances as being more probable than general one. An example of the situation could be an auditor may overstate specific risks and underestimate more general ones, like focusing on audit effort on material account balances only without looking at a significant risk that might be associated with an immaterial account balance. So suppose if you have an estimate of deferred tax that is to be made, or an estimate that is there in the balance sheet, expected credit loss, for example, is a very small number that is appearing in the balance sheet, whereas something that is very routine, very large, the auditor concentrating on the large number in the financial statements, doing efforts for that number, but not paying attention to the expected credit loss estimate, which might have been assessed as a small number because of a faulty estimate or estimation being done. That is the other bias could be outcome bias, which means that sometimes the, the auditor tends to believe, or people judge the value of an action based on the outcome rather than whether the action itself is reasonable. For example, an auditor may not exercise professional skepticism because the auditor may believe that if he carries out 5, 6, 7, 8, 10 steps that are essential to respond to a fraud risk, the auditor may not find anything and therefore may get criticized, right? Why did you do so much of thing? Don't you trust us? So outcome bias is another thing that comes into play. Uh, Groupthink is another bias that arises sometimes, overconfidence, stereotyping. So all these are biases, right? That overconfidence, for example, people tend to believe that their abilities and judgments are better than what they actually are. Um, these all biases play a significant role in skepticism. One way or the other, these tend to stop the auditor from making right judgments. Challenges to exercise the professional skepticism. So, you know, what are the situations in which it becomes difficult for an engagement team member to exercise professional skepticism? So if the engagement team member has long standing relationship with client personnel, there are chances to be blinded by that rapport, which influences the way the evidences or explanations by the provided by the client are perceived. There are possibilities of overlooking red flags in an effort to maintain audit relationship with the client, which is important for the firm. There are also tendencies to avoid significant conflict or bitterness that may act as a barrier to exercise of professional skepticism. Conflicts are always difficult to handle, and people might be tempted to avoid it. Certain incentives, pressures within the team might make the auditor, uh, you know, or put the completion of audit as a priority, and much more importance might not be given on skepticism. So, I mean, complete the audit on time, lack of resources, lack of training and proper expertise also acts as one of the major barriers for exercise of professional skepticism. If workload of the people working in your engagement team is not appropriately managed, this may also act as a deterrent to exercise of professional skepticism. So if you have people who are working on 5 listed entities at a single given point of time, rest assured their skepticism might get challenged. They will simply want to complete the work without brainstorming about skepticism, without looking at properly the things that are coming in their way during the course of audit. Complexities of the business transactions is increasing day by day, so lack of understanding of those transactions would deter exercise of professional skepticism. How do we enhance professional skepticism? I think whatever are the deterrents that we have talked about in the previous slide, if all those deterrents are removed, then the exercise of professional skepticism will become easier. But I think the most important thing that, to my mind, that appears is to have a culture that support exercise of professional skepticism, culture at the firm, culture within the engagement team, to challenge the management, to coach the people within the team, to look at the information with a lot of skepticism in mind, making sure that whatever work is being produced by the engagement teams is appropriately monitored within the firm at appropriate, you know, times. All these are measures to enhance skepticism. And one thing that I see, I mean, how regulators are doing this, okay, we'll come to it a little later. How is professional skepticism evidenced? Now, like I said, it is maintenance of mindset, right? Now, a question that often comes is how do you evidence that you maintained that mindset when you carried out the audit, right? So professional skepticism is often demonstrated in all the work that an auditor carries out during the audit. Now, these audits normally involve a lot of discussions, both formal and informal. It could be with those charged with governance, with management, with client staff, and within the audit team. Documenting important points that arise from these discussions, uh, is required by the auditing standards. Now, when you document, for example, when you are communicating with those charged with governance, right? When you are communicating, you would communicate a significant matter to those charged with governance. You should document why the auditor consider a matter a significant matter or a significant accounting practice, or how this was dealt with in an audit of financial statements. What are the evidences that you examined, uh, you know, when you dealt with the significant matter? Uh, what is that you discussed within the engagement team? Did you come across any suspected non-compliance with laws and regulations? If you formed any significant decisions, conclusions on your audit engagement, how did you form? What evidence did you evaluate? How did you document? Right. So, your documentation should also be very clearly showing the linkage between the information that you gathered the planning stage. How did you identify the risk, and how did you respond to that risk? So all these, I mean, the entire documentation that you create, or that you do when you're doing your audit in accordance with SA 230, should be able to demonstrate compliance or demonstrate that professional skepticism was uh, you know demonstrated during the course of the audit. So documentation is the key. These are the factors what you see on the slide. Normally, if they are documented in relation to any significant matter, evidence of skepticism can said to be present. Now, let us see how do we address the expectation gap. I think for the audit firms, it has to be a proactive self-introspection only. Do not wait for any external inspection to happen. Do not wait for anyone to tell you what needs to be done. SQC1 requires monitoring activities to be conducted within the firm. Based on your monitoring activities, you will know, accountants will know what are the things that are required. First few things that comes to my mind is, if we were to work on reducing this gap, we need to change the tone at the top at the firms. Please consider, when you are accepting new engagement, that while you are accepting an engagement, there is no compromise on the quality of delivery that happens. Make sure that the not the firm and all the people at the firm are cognizant of what the requirements of the standards of quality control are, what the requirements of standards on auditing are, and what are the ethical principles to be complied with. make sure that the resources are appropriately allocated. One thing that is being talked about even at the international forum is, like I said, Bryden Committee said that fraud lessons should be there for the auditors. It may not be possible to have separate forensics team in all the firms, but does it make sense to go through some kind of small course on inquiry, investigation, uh, that on the questioning skills, that's very important. Invest in the methodology, invest in technology, because this is again going to be one of the areas where practitioners are likely to fall short, or likely to see that a lot of effort has to go into data analytics, artificial intelligence, and last but not the least, continuing professional education. So this is what the firms need to continue to do. Most of this is basic. There is nothing new. Reflecting back on what NFRA chair said, go back to basics, and within our firms to make sure that we are actively working towards reduction of the expectation gap. On regulatory front, I think one can bucket uh, how the expectation gap is to be bridged between three, four areas. One is the external inspections. Definitely, people are gearing up. People are making sure that they do not falter on their audits because of external inspections happening. It should have been the other way around. External inspections should not be finding out anything, and the audit should be of good quality. Disciplinary sanctions ensure that people discharge their role properly, but there has to be enhanced corporate governance and accountability. That is one thing that is expected of regulator, that people at the management, people at those charged with governance, they are also asked, they are also made accountable when something goes wrong. And last thing that is important from a regulator's perspective is to bring more clarity on existing standards and new standards, which means there has to be knowledge dissemination, clarity amongst public on what auditor does. There has to be a lot more seminars which the AASB is right now organizing, making sure that all of us understand and implement auditing standards properly. Uh, uh, Whatever common issues are getting noted or are being talked about, more clarity has to be given around that. If we look at some proposals globally, there are 3, 4 standards that are getting revised. There is a suite of quality management standards that RAASB is also working, which perhaps will bring in enhance the quality, enhance the, try and bridge the gap, at least performance gap to some extent, knowledge gap also when we have sessions, when we talk about these new standards, when they come up with the regulators, with the public at large. I think conclusions and key takeaways from my side is expectation gap. Can it be completely eliminated? Answer appears to be no. But can it be narrowed down? Answer is yes. First key of narrowing down is the performance reduction of performance gap, which is in our own hands. But otherwise, the knowledge gap can be reduced by enhancing communication between auditors and stakeholders. Uh, if the reports are made more transparent and more clear, educating the public about the nature and limitations of audit. And yeah, the second takeaway is today auditors, accountants cannot survive without complying with the standards in entirety. And when we talk about compliance of standards in entirety, it essentially has two features or two things. One is risk assessment has to be as thorough as possible. The procedures that you design must address uh, the risk that you have identified, right? So it should not be, simply carrying out routine procedures should not be the, you know, should not be the normal way of addressing fraud risk. You must specifically design your procedures and address each of the fraud risks. And the fourth takeaway is that skepticism cannot be exercised, which is key to responding to fraud risk, unless the ecosystem within the firms are very good, which means people are adequately trained, they are appropriately evaluated for their performance, audit methodologies are refined, audit outcomes are monitored, and external peer reviews and quality assurance process, whatever findings are there, are properly addressed. I think this is what I had to say. I thank in AASB, I thank uh, all my teachers, my chairman, Shri Sanjeev Singhal, vice chairman, Vishal Doshi, my colleagues, Ashish Gupta, Naisa Parekh, and Sangeeta Chabra, who have helped me make this presentation. The sources that I used are listed in the presentation. You can note it down. Possibly you can get it circulated also. These are freely available on the web and can be downloaded and read by all the participants. Thank you so much. Over to you, Hitesh ji.
Thank you so much, Heath sir, for such a nice and elaborative session. सर बाकी आप एक बार केस स्टडी 3 पे एक बार आप दोबारा स्लाइड लेके जा सकते हैं, उस पे कुछ क्वेश्चंस अभी.
Let me just share my screen again.
यस सर, केस लॉ थर्ड सर, we haven't have questions or answers for that particular case law.
Who can share? Are you able to see my screen?
Yes sir, it is visible.
हाँ जी.
So members, it is requested to give the answers for case law 3. In the meantime, we can have the Q&A sessions. So Lalit sir, first question is, with most effective controls in accounting, why are there so many frauds in the corporate world in the recent years as well?
Okay. With so many controls being in place, why there are so many frauds? So the answer is within the question only, sir. I mean, frauds have been always there. It's the human greed that leads to frauds. And when we look at the fraud triangle, it talks about incentives, right? So human greed is represented by incentives in the fraud triangle. And despite being so many internal controls in place, means that the opportunities or the internal controls were not appropriately designed or implemented, which essentially leads to creation of opportunity. So there is greed, and then there is, it's like if I have, I'm sitting in my home office, and this room is normally outside of my house, which means that any outsider can come if I open the door. And if there is money, 10 lakh rupees lying on my table, right? What are the chances that it will get picked up? If there is no door in my room, very high chances. If there is a door, but which does not have a latch or a lock, chances get reduced, but not get fully eliminated. If there is a camera that is installed in the room to see who is coming, who is going, again, chances get further reduced because there is risk of identification. But then everything that I'm doing reduces the chances, but can it eliminate the risk of theft totally? Answer is no. So frauds happen whenever there is greed, there is an opportunity that arises, and there is somebody who is ready to utilize that opportunity.
Okay, thank you, sir. I guess this is the relevant answer for the member's query. So coming to the next question, are normal audit methods plus system audit can help us to detect fraud?
Sir, first of all, I think our responsibility. So this is, I'll address it in two, three portions. The first portion is that auditor is not responsible to detect all frauds. We are responsible to detect only frauds that are material, right? So that's the first statement. That is the current state of standards. The expectation of people where knowledge gap is that we should even be able to catch smaller frauds or immaterial frauds. So that is the expectation gap. Third is, can we detect all frauds by systems audit and through performance of normal audit procedures? Answer is no, because response has to be designed to address the risk. For example, you have carried out IT general controls test work, right? And there are no exceptions that you have found in IT general controls test work. Fraud risk is, and when you study fraudulent revenue recognition in the company, and when you study the transactions, one of the places you identify is if somebody is able to create fictitious customers in the system, then fraud risk, then the fraud can be started at least. Now, what is that you would want to test in the system? You would specifically want to test that people who have added fictitious customer were authorized people from a system configuration perspective, or you may want to test that the changes to the customer database were made by people who are only authorized. Another, so the other way that you come across when you are doing your risk assessment is that revenue can get fraudulently misstated if somebody changes the prices in the system. The pricing table, which is used in invoicing, is changed. Then there is a possibility that financial statements could get materially misstated. Now you would want to devise a procedure that when all changes in the system were made on the price list, which is fed up, who all approve those price lists, whether the system restricts the changing of the prices in the system to specified individuals only, or can anyone else do it, right? So it is very difficult to give a straightjacket answer, as you said that uh, routine test work plus testing of IT control will help you detect all fraud risks. So detection is not, but it may not. Your procedures need to respond to the risk of what could go wrong and how it could go wrong, and then do the checking. And the other side is, if you try and test everything, your audit may become cost ineffective. It will take so much of time that one will not be able to complete the audit in time.
So thank you, sir. Next question is, the risk of fraud is inherent in every organization, whether detected or undetected. Whether fraud can be classified under a model questionnaire of probable risk if fraud is planned and executed in that way.
I didn't get it. Can you repeat that, sir?
Yes, sir. The risk of fraud is inherent in every organization, whether detected or undetected. Whether fraud can be classified under a model questionnaire of probable risk if fraud is planned and executed in that way.
Okay. I have not fully understood the question, but based on whatever I've understood, I'll try and respond to it. See, fraud is always done with an intent to be hidden. That is a key characteristics. And so everybody who will do some small, even a small fraud, would want to make sure that no one comes to know about it, or even if somebody comes to know about the fraud, one will be able to justify why the action was taken. I think that is the first response to it. The second is the probability of fraud, right? Probability of fraud is not, I mean, when we talk about in audit of financial statements circumstance, it is not expressed in number, but it is more expressed in terms of possibility. So probability may not be the right term. I would use that the term as possibility. Is it possible? Can someone manipulate the accounting records like this? This is an answer. This is the question to which an auditor needs to seek an answer when doing the risk assessment. If you come to a conclusion, yes, it is possible in the circumstances, then you devise your procedures to see if somebody has utilized this possibility and has done a fraud or not, or whether financial statements are fraudulently misstated. So probability ki jagah, I think we should use the word possibility. And when we teach auditing to our new students or people who are getting promoted to the next level, uh, we talk about I'm forgetting that term. What could go wrong, right? So once you understand a transaction, what could go wrong is again another way of saying what is the possibility of this being misutilized or misused or misstated.
Okay, so next question is, in audit, how far the engagement letter guides the audit performance, and if it has been broadly addressed in the course of audit, will that be enough for us to prove that the audit has been done in accordance with the same, and expectation gap should be based only on engagement letter?
Okay. I think let us understand what engagement letter is. Engagement letter, and why do we have engagement letter? First is a contractual obligation, right? Whenever we carry on or do any work with anybody, we need to have a contract. So engagement letter serves as a contract. Second thing, which is most important, is the purpose of the engagement letter is to make sure that the management not only acknowledges their responsibility, management and those charged with governance not only acknowledge their responsibility for internal controls, for preparing financial statements, for giving you access to the information that you need for the purposes of audit, but also there is a written agreement and evidence of preconditions of doing an audit. One of the preconditions of doing an audit is management giving you full access, correct and accurate information, honest answers to what you're responding. If this precondition is not there, and these preconditions are mentioned in SA 210, if these conditions are not there, will you be able to do the audit? Answer is no. So the moment you come across that you are being told statements, being given told statements that are false, the moment you come across that the explanations that you are giving, you are being given, are not good or are given to you with a bad intention, while there could be other implications that need to be examined in terms of SA 705, one has to necessarily consider what is the implication on the preconditions of an audit. What are the implications of the evidence that you are gathering on representations that you are going to take from the management? So engagement letter is just a contract which provides the basis for us to start the audit, which provides the basis for us to ask for the information, which provides the basis for us to ask for the fees that we will charge. Nothing more than that. So engagement letter cannot demonstrate exercise of skepticism or compliance with standards on auditing. That is demonstrated by the audit documentation that is prepared under SA 230.
Okay, thank you, sir. Coming to the next question. Normally, statutory auditors are expected to look into detailed financial matters, and internal auditors do specific area-wise audit for avoiding duplication of work. Internal auditors may leave such kind of financial audit in its scope of work. In such case, whether internal auditor can be held responsible for such material misstatements. This is the question, sir.
Just repeat that once, sir.
So, if we summarize the question, the member is asking there are certain areas which are overlapping in nature, which statutory auditor and internal auditors do. What if in such a scenario, internal auditor does not do the work? So will he be held accountable?
Okay. So I think, first of all, let us understand what the auditor's role is. Auditor's role is to express an audit opinion on the true and fair view presented by the financial statements.
Listen, the question is from viewpoint of internal auditor. Will he be held accountable? Okay, okay, sir. Okay, okay, sir.
The question, I think the first premise of the question is areas are overlapping. Now, when we say that the auditor's job is to express an opinion on the financial statements, where does the auditor's job overlap with that of the internal auditor? Section 143 of the Companies Act, does it talk about internal audit?
No.
So there is no question of overlap. An auditor will be held responsible if the audit work is not appropriate. And the audit work that the auditor is supposed to be doing in accordance with the standards on auditing, SQC1, Code of Ethics, and all those things. What happens to the internal auditor if something goes wrong? What happens to management if something goes wrong? What happens to those charged with governance if something goes wrong? Is something that cannot be talked by an auditor. And as an auditor, I can only look at what my obligations are and what work that I have to do. I tomorrow cannot get up and stand up and say, this was to be done by internal auditor. There is nothing in my work that is to be done by the internal auditor.
Okay, sir. Next question is it not better for the management to do retro testing so that in case new software or new or updated risk management system is introduced, the management may be able to avert any consequential loss of business or money compared to historical data of fraud in the bank organization, and the auditor goes through the same. So the question is regarding retro testing of new softwares.
I think whenever any new software is implemented, it is thoroughly tested for the outcomes it is producing, which is normally known as UATs, user acceptance tests that are done. And depending on what type of software it is, what function the software does, this is retro test could be one of the tests that is essential to complete the UAT and must be done in the circumstances. If it is not done, retro test, if it is not done, it will fail your one of the IT general controls that applications are not tested before they are put to use and could have larger implications on the audit, which essentially means that when doing your audit, you might have to ask the management to test the software for you to see whether it is producing appropriate results or not. Yes, it is important. Retro testing must be done
Yes.
where it is relevant.
So last question. In case fraud is detected and duly accounted for and disclosed in the notes to accounts, whether auditor is still required to report it in his audit report, and in case yes, then an EOM will suffice.
See, audit report why and where somebody would report in an audit a fraud that is already disclosed in the financial statements. Let us take it by way of an example. Suppose there was a fraud where the construction engineer of the company booked false invoices of construction of building, and you know, in a 15 crore project, he incurred 16 crore rupees. 1 crore is what he siphoned off from the company. Now, this 1 crore is shown in your financial statements as fraud loss, and explanation is given that this fraud has happened within the company. Your profit has been reduced by 1 crores. It is appropriately disclosed. Why will auditor mention this in the audit report? Because the financial statements are truly reflecting what has happened during the year, right? Including fraud. The financial statements are not materially misstated, though the fraud has occurred. But the financial statements are rightly showing. So fixed assets are shown at 15 crores, which is the right amount of bills that are booked for fixed. 1 crore is shown in the profit and loss account as fraud loss. So to my mind, there is no qualification. Financial statements give a true and fair view. Now the question of EOM. If you believe that, suppose the entity had a profit of only 1 crore, and because this fraud was identified and loss entry was posted, the profit became zero. Now, as an auditor, you will have to form a judgment whether you should draw attention of the users to this already disclosed notes in the financial statement to say, look here, while the profit and loss account shows zero, this is because of the fact that there was a 1 crore loss that had occurred. While my opinion is not qualified, you may read it in the notes, so that reader is able to appreciate if that loss would not have happened, probably the company would have got a profit of 1 crore. Just to remind you, EOM is only a situation where you draw attention of users to an already existing fact in the balance sheet. It has got not. So you need to exercise your judgment whether mentioning of this is useful in your audit report or not, and document your judgment and conclude accordingly. In the example, the way I have cited, it is possibly useful for the user to read, right? But if it is a 25 crore profit company, I may choose not to make an EOM also. I hope I have confused you fully, but I think that's the answer I have for the question.
At the end, it is all about the personal judgment of the auditor.
Yes.
So thank you, Lalit sir, and I hope all the question answers have been resolved. So thank you so much, sir, for giving your valuable time for today's session. अब मैं इनवाइट करना चाहता हूँ हमारे ICI person अनिल जी को. अनिल जी, take over to you and for the closing remarks. Thank you, sir.
Thank you so much, sir. At the end, it is my proud privilege to propose the final vote of thanks. And from the core of my heart and on behalf of Auditing and Assurance Standard Board, I extend my heartiest thanks towards to Lalit Kumar ji for a wonderful deliberation. He has covered all the aspects relating to his deliberation, as well as throughout 2 hours he has spoken. And it is again, I know, sir, it is one-sided deliberation, and immediate members' responses were not there. And during the case studies, also some technical glitch were also there. But there were so many members' queries, and you have handled in a very efficient manner. And frankly speaking, I have gained a lot through your deliberation, and hope our members have also immensely benefited with your expertise and deliberation, sir. So once again, thank you so much for your expert deliberation, as well as the sharing the expert advice with all the members. I also extend my heartiest thanks towards the Honorable Vice Chairman of Sonipat branch, C. Hitesh Dalji, for sparing your valuable time and moderating this today's webinar. As we all are aware that AASB is always in this because since starting we are in the beginning of the year, we have targeted that we will reach to the every member's home, we reach every member's office with the standards of auditing. That's why we are conducting here today's 144 CP program on the basis of only relating to the standards on auditing and various auditing aspects. So thank you so much, Hitesh ji, for joining us and moderating the webinar. Thank you so much, Lalit sir, for your valuable as well as expert opinion. Thank you so much, sir. Thank you.
Thank you, Jake. Thank you. Pleasure.
Thank you, sir. And I also thanks all the participants of today's webinar. Around 2,100 members were live throughout the webinar, sir, during your deliberation. Around 2,300 members were there. And I also request all the members to join tomorrow for another wonderful webinar. That is the key consideration while auditing the BRSR tomorrow at 3 p.m. Thank you so much, sir. Thank you. Thank you. Thank you.
Okay, sir. Thank you.